Welcome to the world of Forex. From the financial market to pips and leverage, we break it down fast. Focus up, learn quick, like, subscribe, and let's begin. Financial market. The financial market is a place that connects two people: investors, people who have money; borrowers, people or businesses that need money. One important part of the financial market is Forex, also known as foreign exchange. Types of financial markets. The financial market is made up of different sections, each with a specific purpose. Here are the main ones. Foreign exchange market, where currencies are traded. Stock market, where company shares are bought and sold. Bond market, where governments and companies borrow money. Commodities market, where things like gold, oil, and silver are traded. Money market, for short-term lending and borrowing. Derivatives market, financial contracts based on price movement. Futures market, agreements to buy or sell something at a future date. Insurance market, used to protect against financial risk. All of these together form the financial market system. Foreign exchange market, who is involved? Now let's focus on the foreign exchange market. Many participants take part in this market. Brokers, they connect traders to the market. Commercial banks, they exchange currencies for businesses and clients. Companies, they trade currencies for international business. Individuals, everyday people like retail traders. Central banks, they control and stabilize a country's currency. Together, they keep the Forex market moving 24 hours a day. What can you trade? In trading, there are different instruments you can trade. Indices. These measure the performance of a group of major companies. For example, the overall stock market performance. Forex. This is the market where currencies are traded, like EUR/USD or GBP/USD. Futures. A future is a contract. It allows you to buy or sell something later at a price agreed on today. What is Forex, or foreign exchange? Is simply the buying and selling of money. It's how people trade one currency for another to make a profit. For example, you buy euros using US dollars. If the euro becomes stronger, you sell it later and get more dollars back. That difference is your profit. Buy versus sell. How traders make money. In Forex, you can make money two ways. You can buy or you can sell. When you buy, also called going long, you believe the currency will go up, so you buy now and sell later at a higher price. When you sell, also called going short, you believe the currency will go down, so you sell now and buy it back later at a lower price. Let's talk about currency pairs. And don't worry, this is simpler than it sounds. In Forex trading, you're not just buying money, you're comparing two currencies. It's like asking a simple question: which currency is stronger right now? How currency pairs really work. Every trade in Forex is a pair. One currency goes up, the other goes down. The one that performs better becomes stronger, and that difference in strength is how traders make money or take losses. Think of it like this. Imagine two countries. If one country's economy is doing well, its currency usually becomes stronger. If the other country is struggling, its currency becomes weaker. When you trade a currency pair, you're simply choosing which one you believe will win. Major currency pairs, beginner-friendly. Now let's look at the most popular currency pairs. These are called major pairs, and they are great for beginners. EUR/USD, Euro versus US dollar. GBP/USD, British pound versus US dollar. AUD/USD, Australian dollar versus USD/JPY, US dollar versus Japanese yen. USD/CHF, US dollar versus Swiss franc. USD/CAD, US dollar versus Canadian dollar. NZD, New Zealand dollar versus US dollar. Base currency and quote currency. Now this part is important. Every currency pair is written the same way. The first currency is called the base currency. The second currency is called the quote currency. The base currency is the one you're focusing on. The quote currency shows its value. Example: USD/JPY. Let's take a simple example. USD/JPY. USD is the base currency. JPY is the quote currency. This pair is asking, how much Japanese yen is needed to buy $1 US? If the price goes up, the US dollar is getting stronger. If the price goes down, the US dollar is getting weaker. It's like a comparison. Two currencies, one pair, one leads, the other follows. And that movement is what traders trade. Let's understand three very important Forex concepts: lot size and leverage. Think of them like distance, volume, and power. 1. What is a pip? Let's start with pips. A pip shows how much the price moves. Think of a pip like distance. If a price moves a little, that's a small distance. If it moves a lot, that's a long distance. So in Forex, pips measure the distance the price has traveled. More pips moved means more price movement. 2. What is lot size? Now let's talk about lot size. Lot size means the size of your trade. Think of lot size like volume. If the volume is small, your profit and loss are small. If the volume is big, your profit and loss become bigger. This means bigger lot size equals bigger profit per pip. Bigger lot size equals bigger loss per pip. So lot size controls how much money you gain or lose for every pip. What is leverage? Now comes leverage. Leverage allows you to trade with more money than you actually have. Think of leverage like credit or borrowed money from your broker. Leverage gives you power. With leverage, a small amount of money can control a much bigger trade. This can increase profits, but it can also increase losses. Simple example. Let's make it simple. Pips, how far price moves distance. Lot size, how big your trade is, volume. Leverage equals how much power you have, credit. Distance times volume, powered by leverage. That's how profit and loss are created in Forex.